Hi, Carol. How are you?
Hi, I'm very well. How are you?
Not too bad, thank you. I can see we have different backgrounds, and yours is more
You're
realistic,
on the
and mine.
beach in the winter.
Yes, I know. I hope this is the real situation, but I'm sure for prospective students, if you join us the next year, you would have plenty of time to explore this beautiful beach as well. So, Carol, could I please invite you to give a very short introduction and start your lecture, if that's possible?
Yes, of course. Shall I start sharing my screen now?
Absolutely.
Okay. So you should be able to see my slides here, and I'll do that now. Can you see the slides and can you see me? What can you see?
Perfect. Yeah, it's
Okay,
all
good.
perfect.
All right, so that's the title of the talk, DeFi and the Future of Banking and Finance. And just to introduce myself very briefly, because we don't have a lot of time and it's a massive topic. DeFi just explodes every year. There's more to learn and more to talk about. So I'm going to go very quickly. I hope we don't run out of time, but we shall see. I really want to have time for questions at the end, of course. So just to let you know, if you want to find out more about me, then go to my website, which you can find here, and it's coalexander.com. Okay. So let's have a look at what I'm going to be talking about. Just as an introduction to the whole thing about DeFi, let me liken the current web to its predecessors in the way that I personally view them. So although, people called Web 1.0 the read-only web, its role was really one of disseminating information only. And then Web 2.0, people call the interactive web, but its main role has been to turn commercial enterprises into online experiences for everyone. So, we're now beginning to move towards what's called Web 4.0, in fact, already people are using that term for the Internet of Things. But I want to focus on what I call Web 3.0. Some people call it the semantic web, because, of course, when you type things in, Google already knows what you're looking for. But for me, Web 3.0 is all about DeFi. And it's you don't suddenly switch from one web to the next. It emerges gradually and evolves over a period of time. So already now you may find yourself looking at something that isn't an ordinary app, but it's a dApp, a distributed app. Instead, you wouldn't know because the interface looks exactly the same. But the difference is the security and the immutability, which means you can't change things. So whereas an ordinary app would connect to an insecure server that could be hacked via an API, an application processing interface, the way that dApps interact with their means of storing information, which is a blockchain, uses a smart contract. And I rather like this analogy. I just thought of it the other day. I'm sure other people have used it, but maybe not. But the point is that we can think of these essential elements of DeFi, smart contracts, blockchains, cryptocurrencies, in a sort of analogy of a car. Okay, so the blockchain is like a motorway, okay? And there are many different motorways that are connected by things called oracles, but we can talk about those later. But a blockchain is like the motorway. A smart contract is like a car that drives along the motorway. And cryptocurrencies are like the gas or the petrol or the power that drives the smart contracts along blockchains. So I'll start by explaining that in much more detail. So the first part is blockchains, crypto assets, and smart contracts, okay? And then I'll be talking about the future of financial markets, already beginning today, and the challenges that are faced by regulators and how to govern decentralized autonomous organizations and decentralized finance projects. Okay, so the first part is about blockchains, crypto assets, and smart contracts. So yeah, everybody's heard of Bitcoin, And sometimes you see a capital B, sometimes you see a little b. Actually, they're different. The capital B is the blockchain and the little b is the currency. And you can trade Bitcoin without the Bitcoin blockchain, if you see what I mean. People talk about Bitcoin uses so much electricity. Well, the Bitcoin blockchain does, but the Bitcoin cryptocurrency exists independently of the Bitcoin blockchain. In fact, most of the Bitcoin has already been mined. 18.5 million coins exist today. There's only another 2.5 million to come, and then that's it. Bitcoin is not a fiat currency. You can't print it just like dollars. And in a sense, that's how it gets some sort of fundamental value, although that is still rather contentious, whether there is any fundamental value in Bitcoin itself. But crypto assets are so much more than Bitcoin. And people that don't understand that are very quick to dismiss. You know, when new innovations come along, some people get quite threatened, and so they ignore it. And then they start making fun of it. So we're getting a lot of skeptics making fun. We're now at the stage actually of fear. You know, actually this really is something. What are we going to do about it? So the most important thing to do is to arm yourself with the information you need to keep ahead of the curve here on what's happening so fast in DeFi. So what is a blockchain? A blockchain is a distributed ledger. A ledger is just a document of information, you know, the old-fashioned ledgers where people wrote everything down. That's a ledger, like the accounts, you know, the assets and liabilities sort of ledger, but a distributed one. So it's kept in many copies, and it's digital. So it's stored in many different machines in blocks that are cryptographically linked in a chain. And there are private and permissioned. Often permissioned is owned by a consortium like the Axoni banks. They have a permissioned blockchain, or a private blockchain owned by a healthcare organization. And there's a central authority there which allows people to make entries and governs the protocol in that blockchain. They're still cryptographically linked, but there is a central authority. But DeFi mostly uses public blockchains, and these are run by a decentralized peer-to-peer network, and there isn't a central authority. Trust is replaced by something called a consensus protocol. You've probably heard about this proof of work that uses up so much electricity in the Bitcoin blockchain. So if we look at this picture here, we see a block which will be a lot of information which is hashed together cryptographically and compressed and compressed and compressed into hexadecimal numbers, and then the peg, like this little thing here, which is the last block previous hash, is then built upon to get the next block. And so on. You get this one hexadecimal number, which is the peg, and it's built on like that. And if you try to change something earlier in the blockchain, then that peg changes, and then everything else after it changes. So here's a look at the very, very simple, almost joke, Bitcoin blockchain and the Bitcoin currency. So here I'm looking in the block explorer, and you can see the blocks are about every 10 minutes, a bit slow at the moment, but then as more miners come on, mining nodes come on board, most of the mining now has moved to the US. And so we are a little bit early for the US miners to come on board. The hash rate, as we call it, will speed up soon. On average, 1 block per 10 minutes. And there's a halving of the amount of Bitcoin that is produced every time a block is made, every 4 years or so. And that's how it becomes a non-fiat currency. That's how the mechanism whereby the supply is limited. And if we look at the latest block, here's the latest block, we can see the previous block. This is the peg that I talked about. It has to have lots and lots of zeros in it. And this is the hash of all the transactions in the block. They get hashed and hashed and hashed together to get a 64 length or 256-bit hexadecimal number, and so on and so on. But this blockchain is a very, very basic sort of blockchain. It just carries Bitcoin transactions. You can wrap it up in what we call second layer protocols to do other things, but really it's just the basic experiment that Satoshi Nakamoto started more than 10 years ago. Now, crypto assets are far more than Bitcoin. We call them cryptocurrencies usually, but crypto asset is a more general term because it includes currencies, yes, like Bitcoin or Ripple, which are only used to transfer value. But also there are securities. These are crypto versions of capital assets, you know, stocks and bonds. Then there are things that are more like commodities, like Ether, Litecoin, and DOT. For example, a small unit of Ether, which is called a gwei, is how we measure the gas, i.e. the petrol or the energy to run the cars around the Ethereum blockchain. And then there are all sorts of tokens, thousands and thousands of them. I mean, probably at the moment there are 6,000 or 7,000 active tokens, but over time, I mean, some of them have just gone dead, but there must be easily more than 10,000 tokens. And these some people call them coins, but the difference between a coin and a token is that a token rides on another blockchain using a smart contract, usually Ethereum, but more recently DOT, EOS, and other blockchains like Solana and Tron are also carrying a lot of smart contracts for tokens. Two types of tokens: there's the fungible or perfectly exchangeable ones that are often used to crowdfund DeFi projects, or they're used for memberships and so forth. These have a protocol called ERC20. It's the Ethereum wrapper that you actually have to put around Bitcoin because it's not an ERC20 token. So if you want to send Bitcoin over on a smart contract instead of the Bitcoin blockchain or something like that, then you have to wrap it up in an ERC20 wrapper. And then we have these NFTs, non-fungible tokens, art, collectibles, real estate, and they have a slightly different protocol, the ERC721. And as long as they're standardized according to these rules that Ethereum have made, then they can be transferred very easily. Then we have stable coins, actually they're tokens, but the stable coins like Tether or DAI. These are like crypto versions of the US dollar or gold or euro, you know, but mostly it's the dollar that we have these stable coins. And then we have central bank digital currencies like the sand dollar in the Bahamas, the CBDCs, which are taking a long time to develop, and there's a good reason for that, but that's not the topic of this talk. We're talking about DeFi. What are smart contracts? Smart contracts are programs stored on a blockchain that runs automatically when you've got if this, then that, these conditional statements. If this happens, then automatically something else happens. So you have to have lawyers. You have to have smart lawyers. In fact, you have to have smart contract lawyers nowadays, because lawyers, like many other professions, insurance and doctors and so forth, are being replaced by technology. It's not just the deliveries or the supermarket checkouts that automation is replacing now. It's the professional services too. So if you're a lawyer, then you need to be a smart contract lawyer, because you need to know how to write an agreement that can be programmed properly using the necessary coding implementations. Then you can put it on the Ethereum or another blockchain and it will be automatically executed. And that does away with the need for so many different intermediaries. Often smart contracts are used for things like trade finance. The global supply chain, for example, might involve 20 different intermediaries: the port authorities, the banks underwriting, the importer and the exporter, and so forth and so on. So the insurance and so forth. So with a smart contract, these entities have a real-time true state of what is happening when they are shipping tomatoes from Israel to Iceland or whatever it is they're doing. And it speeds things up enormously. If something goes wrong, you look in the blockchain, you know exactly where the holdup is. Any type of cash flow financial instrument, interest rate swaps, any type of structured product can now, instead of just being OTC, it's on-chain as well. Peer-to-peer loans, of course, these have been going for some time. I'll talk more about those, and insurance later. So these are examples of smart contracts. Now, the Ethereum blockchain is completely different to the Bitcoin blockchain. This was built to carry smart contracts powered by what I call gas. So let's have a look at this. Oops. I should be able to, what's happened to my mouse? Hope it doesn't run out of battery. Here it is there. Okay. So this is the state of the Ethereum. It's a sort of control panel for the Ethereum blockchain. So you see this is the latest block, 13,448,000. They are much quicker. They're not 10 minutes. It's average about 15 seconds a block. There was a block just mined then. Average block time actually at the moment is 13.63 seconds. This is the hash rate, because they're still using proof of work, but it will transition to a much better form of consensus algorithm, which is called proof of stake, which doesn't use electricity. It uses a tiny bit, but not very much. Here is a map of the master nodes. Master nodes, every big mining pool, there aren't very many of them, has its own master node. And the master node is like a relay transmitter. It's a very fast, so the latency that you can see here, where's the latency? This propagation time, the latency is greater on some of the other nodes, and very often the lower the latency, the more likely they are to build the next block. Then are surrounded, each master node feeds a lot of farms in the pool. These farms share a common memory pool of the validated transactions which they take to build a block. So we can see these are the main pools, not that many of them. Now, these are the main pools, and within each pool, for example, this has 256 mining nodes, this has 137, this has 50. The more mining nodes you have, the more likely it is that you'll build the next block. Gas limit means that when you have a smart contract in a block, you need to have an upper limit, otherwise the smart contract could fail and use up all your money. So, and then we have the Ethereum blockchain that isn't like the Bitcoin. It's like a beautiful necklace with all sorts of curves, like a sort of filigree necklace. And so they have loops that go back into the blockchain rather than the Bitcoin blockchain. You waste the transactions. Anyway, so that's that. And if we look inside the Ethereum chain, then you can see there's an awful lot more than just smart contracts. So this is the block. This is the reward. You get Ether still for mining blocks. Again, it's like Bitcoin, it goes down and down, the amount of gas used and so forth. Then if we look inside the block, then we have, let me have a look what I was going to do here. Look at this miner flexpool.io. Okay, so that particular mining pool, they have internal transactions within other farms in the pool. They also do ERC20 token transactions, which is one of the main smart contracts. Do they have loans? Yes, they do some loans on it, and so forth. So this Etherscan is so much more than the block explorer for Bitcoin, because the blockchain itself is so much more advanced. Now let's move on to the next part of the talk, which is about the future of financial markets. And now I'm going to be talking about all the risky new types of financial institutions and the instruments that are emerging in the DeFi space, and the unregulated companies which are taking on the traditional role of banks, insurance companies, other types of financial services like custody or brokerage. It's all coming with this immense wave of DeFi to take over the traditional business of banks and other financial services. And the innovation is so fast, we have to move quickly to understand this, because not enough people do. So let's first talk about something like Coinbase, which many of you may have heard of. This is an example of a centralized exchange. So, you know, if you have a stock like Apple, you can trade it on the New York Stock Exchange and not many other places. Whereas Bitcoin, you can trade on probably about 100 or 200 different exchanges. That's not even counting what we call decentralized exchanges. But let's just talk about the centralized exchanges. Now, you can actually trade on centralized exchanges not going on a blockchain at all. If you transfer fiat currency, so you put dollars rather than Tether, which is the stable coin for dollar, one of them, then that's not recorded on a blockchain. Fiat transfers aren't. And anything that happens in Coinbase is not recorded on the blockchain. And then if you offboard, as we say, take your dollars or euros back from Coinbase, there's no record at all, all right? It's only on the decentralized exchanges where everything is on the blockchain, mined into blocks. So that is completely transparent, although anonymous or pseudonymous. Everything has got wallet addresses with hexadecimal numbers, which you may be able to trace IP addresses and things like that. But it is still very difficult to follow the decentralized transactions on blockchains. And there are two types of centralized exchanges. There's regulated ones, like Coinbase is regulated. The CME, they trade futures. LedgerX trade options. They're licensed with the CFTC. It's the only derivatives exchange that is open 24/7. The thing about these exchanges are they are open, you know, even holidays, everything, 24/7. They never close. CME does close, so it's never going to have the advantage that other centralized exchanges have. And there are loads of them. These exchanges like Binance, Bybit, Huobi, OKEx, BitMEX, Bitfinex, hundreds of them. And these are unregulated, and they might like to call themselves self-regulated. And they trade thousands of different products, derivatives of all sorts, new types of instruments that we've never seen in other financial markets as well. And they're not just a trading platform, they're brokers. So typically they give you Tether in exchange for fiat currency. So for example, Binance Holdings, which hopefully has been banned from most countries by now, and certainly it is banned in the UK, Binance Holdings would take pounds and then give you Tether so that you can trade on Binance, because Binance only uses crypto, doesn't have any fiat pairs, not like Coinbase. And they operate as custodians, so they keep my pounds, at least they're supposed to. But actually, I know, and if you want to look at the latest blog, that's not what's happening as custodians. They actually need your fiat to prop up the losses they make, because they also operate their own clearinghouse. It's not like, you know, most exchanges in traditional markets, they have to have an independent clearinghouse like the London Clearing House. And everything is operated properly. So, you know, you have a margin account if you're trading exchanges, but you're given 24 hours margin call if your collateral in the margin account goes towards zero. You have time to top it up, but that doesn't happen on these exchanges. And when that happens, they take over, they automatically liquidate your positions. And that's why there's a lot of legal cases going on now against Binance and some of these other exchanges, particularly Binance, because on May the 19th, they pulled the plug and a lot of people got liquidated and lost millions and millions of currency all over the world, from Iceland to Australia. And so this is really something that regulators have to get a grip on. And there are plenty of good companies operating in this space, like LedgerX, and they really need to make sure that the way they operate as a clearinghouse broker and custodian is acceptable by regulators. They're determined to do that. So centralized exchanges also operate lending services if they can. Coinbase tried, but they were stopped by the SEC. But many others do. So, you know, you can follow up any of these links. I'll give Jenny my slide afterwards. I won't go through all the links, but oops, I want to know what's happening with my mouse. It seems to be disappearing half the time. Okay, let me go back here. So, yeah, centralized exchanges offer very high interest. 10% on crypto deposits, very easy. So you become, if you hold crypto and you don't want to trade it, you can just earn interest at a very high rate. And then you can get loans, and they're backed with dollars and other fiat currencies. And the rate that you get is determined by Coinbase or other centralized exchanges. That's how they operate in that exchange, using some sort of Oracle service. Now let's move to decentralized exchanges, and the DeFi innovations are even more remarkable on decentralized exchanges. They're called decentralized because they operate on a blockchain, as I said. Now, they don't have these standard sort of order books, you know, with buys and sells and market makers matching the buys with the sells in the usual traditional manner of regulated markets. They use automated market making algorithms. Here you can see Pancake Swap, the sort of liquidity that you can get if I provide, for example, BNB, that's Binance Coin, or Cake, that's the Pancake Exchange native token. I could earn up to 50% interest, and the liquidity pool of that is about $500 million. If we look here, this is another decentralized exchange that is doing more than just swap token pairs. And once you have a token, an ERC20 token, you can put it on any exchange. There's loads of them, but this is a new one. This is the MC DEX, which are beginning to offer also perpetual swaps with a permissionless automatic market maker. So this is they're just the beginning. And once one person starts doing it, within a few weeks, there'll be many others that were preparing their launch. So what are perpetual swaps? They don't exist in other countries, in other markets, or inverse products. Again, these are innovations just in crypto, leveraged up and down tokens and so forth. So let me just show you the order book of the Binance Tether perpetual. Here it is. This is a standard market because Binance is a centralized exchange. So you can see here is the sells on the red, here are the buys on the right, and here you can see the algorithms. That's all high frequency trading via algorithms being flashed on the sell and the buy side. Sometimes you see quite large amounts. So here you can see somebody is putting in 2 Bitcoin. So, you know, these are trades worth about $2,000 or so. Can you see them coming up here? They're very large. There we are. They're not actually traded, because when you see the actual trades, oh, actually, that was quite a large one. So anyway, the point is that this type of trading is highly leveraged and incredibly risky. And they have proper market makers, designated market makers for the Binance exchange. It's not an automated market making business. So let's just go back. The problem with Binance and other unregulated exchanges, and particularly now Binance, is that the prices are formed on Binance, particularly this Binance Tether Perpetual. It's the nearest to spot with tons and tons of leverage that you can get. Some people call it a perpetual futures. Some people call it a perpetual swap because it has things in common with standard futures or things in common with currency swaps. But the main thing is it's perpetual. Whereas other financial products have a fixed term, this never expires. And the way it's tied to the spot are by 8-hour payments of what we call funding rates. And so it depends on whether the prices are going up or going down. If they're going up, the long pays the short. If they're going down, the short pays the long. And things are so fast here that these funding rate payments have become like the day, because with 24 hours, what is a day? But what happens in crypto is really, 8 hours in crypto is like a day, or even a week in some markets. It's like a day in FX markets, but maybe a week in bond markets. Things are so fast, volatility is so high, it's 100, 200%, even in Bitcoin, let alone the other crypto assets. And there are very large proprietary trading groups, jump trading, of course, but more for longer. We've had places like Alameda Research, but actually it's a lot of prop traders running some very, very good algorithms, Cumberland Capital and so forth, who are driving these prices in the directions that they want, and they're making an awful lot of money. They deliberately create volatility, and then they wipe out the retail investors and they trade on that volatility. Prop traders only make money when there is a lot of volatility, so they use manipulative strategies, which we call spoofing, in order to create volatility. And unfortunately, it's not just Bitcoin or Ether, is obviously the other major crypto currency, or it's a commodity, but we call it cryptocurrency too. Anyway, regulators really have to get to grips with the fact that the entire space of crypto assets, the risks and returns, is being corrupted by these players on these exchanges. On the decentralized platforms, there's a lot of lending and borrowing services. In the news today, for example, the news that Tether has actually not got fiat reserves. A lot of its reserves come from crypto via lending services such as the Celsius network. Again, I suppose I've got time to quickly show this article today from this is a previous article, but there's one today in the FT as well, where the Celsius platform, which is a lending platform, what do they do? If I've got crypto and I deposit it with Celsius, I'll get 17% interest. It's much higher than I would get if I was trying to get interest in a bank on dollars. But what do? They engage in proprietary trading too, but they're no match for Alameda. They're no match for Cumberland. So they've been losing a lot of money, which is why they had to raise actual dollars recently. But they've also been getting Tether on loan for the crypto. And this is just poison. It's propping up the entire space, unfortunately. We've got to get rid of Binance and Celsius and Tether before DeFi actually becomes safe. Anyway, and then there are other platforms which are much better governed than that. Compound, DYDX, and a very good example is Maker, which is a distributed autonomous organization, which is very well governed. And they also allow borrowing of crypto. So the depositors, if I want to loan my crypto, I open a collateralized debt position, obtain a stable coin, and then I can loan the stable coin myself, not via a central counterparty like Celsius, because this is a proper distributed autonomous organization. I just become a member of Maker. I put in crypto, get the DAI stable coin from Maker, and then other people can borrow DAI from me at high interest. And when I want to stop, I just return the DAI, and then I get my crypto back that I use to collateralize that stable coin. Now, other traditional financial services, not just peer-to-peer borrowing and lending, not just the market making, not just exchanges, but also underwriting services, the sort of best effort underwriting services from like an IPO underwriting for what we call these new crypto assets. They're called IEO now, initial CES. The token goes straight to a centralized exchange like Binance, or it goes straight to a decentralized exchange like Uniswap or PancakeSwap. These early investors in the tokens, before they are actually launched, before the day of the IPO or ICO or IEO or IDO, before that day, early investors will pay a lot of money to be the venture capitalists that finance these funds. So here's a very, very successful platform that underwrites IEO and IEOs. It's called Black Dragon. And if you want to be a member of Black Dragon, if you're a white dragon and you've only got 250 Black Dragon tokens for that seat, and that's about $1,000, no, $10,000 at the moment, because Black Dragon tokens are about 4,000, I think, at the moment. And you know, I know a friend who did that, but he didn't really get access to the deals that they were underwriting. You have to buy a very expensive seat called a Black Dragon in order for the Black Dragon services to give you the really good tokens that they're underwriting. And traditional insurers, like Lloyd's, the Lloyd's Atrium Syndicate is insuring what we call a hot wallet. So very often you get a hack of a crypto centralized exchange because they're connected only one peg with the blockchain is called their hot wallet. Then they can take all the stuff into a cold wallet that isn't on the blockchain, but the hot wallet has to be connected so you can get on and off the exchange, and that hot wallet can be hacked. But Lloyd's are now insuring any operational risks in that way. And Nexus Mutual even insures against smart contract failure. So we're getting more and more decentralized services like Nexus Mutual. I know Lloyd's is a traditional one, but this is a new company in the DeFi space, which is specializing in insurance against smart contracts and exchange hacks. Finally, and we should have time for questions, I hope. Yeah. So say a little bit, because there's not a lot to say about the governance and regulation, unfortunately. We've still got a long way to go. The questions are, how can decentralized organizations be governed when the current regulation of financial institutions is all about centralized structures? And it's very difficult for regulators to institutional regulators to have any leverage, particularly when a decentralized organization may not even be registered in any country. So whose responsibility is it? And then how can the markets regulators tackle the crypto Wild West, as the chair of the SEC, Gary Gensler, has called it? It really is. And you've seen some of the things. This is just the tip of the iceberg of what's happening in crypto markets. So how can market regulators do anything about it? So just to say a little bit more about the self-governance of decentralized organizations, the exemplar model is the Maker Foundation. But there are many other distributed autonomous organizations, or DAO, not just the Maker DAO. And if you're a member of a DAO, you are a stakeholder with funds. And so you invest your funds in the DAO via some sort of token like Maker, okay? And you can buy that token on decentralized exchanges and so forth. Now, members of a DAO can vote on any activity, for example, a startup company in the DeFi space. It depends on the amount of stake that you have. So it's a way of, you could also, for example, here you can vote on changes to the actual protocol of the company. So you're actually governing it as well by being a member. Whatever you do, the point is that by being widely distributed and just peer-to-peer with no central authority, you have a share in the risks and returns, things you couldn't do yourself. If you want to invest in charitable ventures, you can't do very much yourself, but if you do it via MakerDAO, then you're sharing all the risks and the returns as well. So let's have a look at the state of DeFi regulation, finally. Well, it's just the beginning. So, you know, I've talked a lot about Tether, and maybe there are some questions we can take about what's happening with Tether. I've made it, and Binance, a special interest of mine the last few months. because yeah, it's really, really concerning. Both the New York District Attorney and the CFTC have fined Tether, but hardly anything, a few millions, you know, it's nothing. To fine them for false reporting or inadequate fiat reserves. Countries have banned Binance, like the Financial Conduct Authority in the UK has banned Binance holdings to stop consumers getting caught up in, you know, giving their good fiat currency, giving their yuan in return for Tether to go and trade on Binance, and then being ripped off by all these big proprietary traders. It's no good. You mustn't do it. Other state attorney generals have investigated, like the New Jersey one is currently looking at the Celsius, the loan sharks that have been taking your money and then using it for prop trading. One of the best companies is Ripple, and that's the one that has been fighting the SEC for a very long time. Why? Because the SEC can go after Ripple because it's incorporated. They go after who they can. They can't go after Binance. They don't know where they live. Ripple is just there. And the point about Ripple is, okay, it's a bit of a threat to the SWIFT transfer system, because that's what Ripple does. It's a cross-border it's a payments mechanism to rival SWIFT, which has had lots of problems. Anyway, that lawsuit is ongoing. China has sensibly banned both trading and mining of crypto until such time as we actually have a set of rules and regulations that protect retail investors. I mean, it's okay if professional asset managers and fund managers are holding crypto portfolios. They're supposed to know about the risks that they face, but not individuals. That's really, you know, stick to stocks and shares, or better still, real estate, bricks and mortar. That's much safer. Anyway, so Binance Holdings, Binance Inc., exchange traded funds are swamping the SEC, and people keep saying every week, we're going to have a Bitcoin ETF. Well, I hope not. Unless it's traded on a 24/7 exchange with a proper license, like Coinbase, for example, that could host an ETF. I wouldn't think that would be too bad, but certainly not traded on the New York Stock Exchange, because it closes. What are you going to do over the weekend when you can't do anything about your crypto ETF and crypto markets are crashing on a Sunday? Anyway, so let's take some questions. The point is that it's really important for universities to move with the times. We don't need to teach people how to calculate a present value, how to look at the capital asset pricing model. Nobody believes in efficient markets anymore. What we need to teach you, and where your future careers lie, is in decentralized finance and other topics like sustainable finance. Okay. So if you want to find out more, there's a slide for our business school. And as I said, I'll make these slides available to Jenny afterwards if anybody wants to get a copy from her, or I can put them up on my website, which is what I normally do when the video is available. Okay, so Jenny, would you like to go to some questions?
We have plenty of questions here. The first one really drew my attention. It was from one of your old PhD students, Ali.
Oh, which one is it?
So Ali asked a quick question.
Oh, Ali. Hi, Ali. How are you?
So they asked, do you feel Celsius network is a risky venue current to earn interest on your crypto?
Definitely, definitely, definitely. MakerDAO is probably the only one I would trust.
Okay.
Why? Well, look at the news today with Celsius. They are using the crypto they get for, they say, mining and other loans, but they're using it for prop trading, and nobody can trade against Alameda, Cumberland, Jump, and other big prop traders that are now moving into their algorithms aren't good enough. So yeah, Ali, put it in MakerDAO.
Thank you, Karen. And another question, some questions I believe that your later on slides covered the questions because they were popped up really early. So if I miss anyone's questions, please do remind me again in the chat box. But I'm just going to go through now.
And I can see there's a lot of questions. My goodness,
yes,
you have to collate them.
Another earlier question was, could you elaborate a bit more about how Bitcoin can exist outside blockchain?
Okay, well, the Bitcoin blockchain is just there to mine new Bitcoins. And that's all it does. It's possible to actually put various what we call second layer protocols on top of any blockchain, all right? And one of the second layer protocols for the Bitcoin blockchain, called the Omni layer, does allow the blockchain to carry smart contracts. But really, rather than use the Bitcoin Omni layer, Ethereum, Solana, Tron, and various other blockchains are much faster and more efficient, particularly those that are based on proof of stake. It doesn't use a lot of electricity. But the point is that these Bitcoins still exist. So when you've got a Bitcoin, in fact, you can go to an ATM called a Satoshi point, and if you like, you can put in dollars and you can get out Bitcoin, obviously digitally. And then you can spend your Bitcoin in various retail outlets. Lots of shops and big companies accept Bitcoin as payments. And none of this is on the blockchain. It's all done through another second layer protocol called a Lightning channel. So the Lightning network is also just the beginning and the end of these channels is on the blockchain. And that allows because it's 10 minutes. Every transaction takes 10 minutes at least on how can you buy a cup of coffee? You can use things called the payment channels, which are, that's probably enough of an answer, yes?
Thank you, Carol. Another question is, how do you think about the importance of liquidity in DeFi lending?
I'm a bit concerned about this because DeFi lending is very attractive. It's attractive because interest rates are being held too low for too long. Now, this is exactly what precipitated the credit crunch, and the credit crunch precipitated the banking crisis, and the banking crisis precipitated the global depression that we're all suffering from. Why? Because Alan Greenspan held interest rates too low for too long. And banks need to find yield somewhere. If banks are not able to earn interest on the loans they give, they're going to seek things like collateralized debt obligations, asset-backed securities, mortgage-backed securities, and worst of all, credit default swaps on all these CDOs and MBSs and ABSs. And, this horrible sort of explosion of credit products is what suddenly collapsed the entire investment banking infrastructure. It's happening again now, and it's happening on DeFi. 17% interest, no wonder. I mean, why don't I go and put all my pounds into DAI and then get 15% interest? Huh? I'm not, but it's a very attractive thing for people to do. But what's happening is that the loan sharks are taking it and then they're using it to try and make their own money on prop trading. They're not doing it just lending and borrowing, although even that is very, very profitable.
So we have another question, and it's quite a short one. So how sustainable are cryptocurrencies, in your opinion?
I think sustainable is not exactly the word I'd give them. So when we use proof of stake or proof of storage or proof of authority, then that's all very green for mining those. But mining is just one thing. Once they're mined, trading is another thing.
Yes, talking about mining, actually, there's a question I think of a lot of people who would be wondering is, do you still think it's worth to mine to make profit?
Yes, absolutely. It used to be very easy. People, you could buy a miner from Amazon. And if you were lucky, you won the proof of work competition you have to have a lot of equipment really, and cool it and so forth. Now, of course, these huge farms are built in warehouses in Alaska or Iceland or places where electricity is cheap, cooling is easy, they may be underground, but it's very difficult to compete with F2 pool or slush pool. I mean, there's 10 major pools that have cornered the market on the major blockchains like Bitcoin, Ethereum, Solana, and so forth.
We have a more complicated question here. Do you see DeFi moving from Ethereum to Solana or any other platform in the future because of low fees?
$1 million question. $1 million
or is the
question.
Ethereum
That's a very good one.
ecosystem too big to be left out?
Is the what ecosystem?
Or is the Ethereum
yes,
ecosystem
that's the
too big?
thing. I mean, we all know that Bitcoin is a joke, and look at it. You know, it's still leading the market. It's sentiment driven, and a large part of Ethereum investment is also sentiment driven. People will go where they think the majority of people will go, and whereas lots of people know about Solana, even more people have heard about Ethereum. And so in terms of the price, I won't say value, I will say price, which is different from value. And the value is very specific. It depends on your utility. Price is something that a market agrees on, and it doesn't have to really represent any value at all. It's just a balance between demand and supply. You know, where the two curves intersect, that's the market price. And so the market price really needs, you know, the supply we know about, the demand, well, you know, obviously people you need to watch for the supply, you need to watch whale alert. Then you see the big movers. Are they bringing Ether or Bitcoin or any other coin? Are they bringing Ether onto an exchange? Sign up to whale alert. That will give you an idea of supply. Demand is usually very sort of retail driven. So that's why the volume on Coinbase leads the market in these unregulated. The volume comes from Coinbase, but the volatility comes from Binance, because that's where the sharks are. But the sharks watch Coinbase for the retail interest. Then they'll find more little fish, more little retail investors on Binance, and they'll create the volatility to eat them up.
Thank you, Carol. And there's another question is from Jefferson. I wonder, what is your vision on the implications of DeFi and the gradual elimination of middle people for economic growth, especially in developing economics?
Whoa, that's a long one. I might have to read that one. Where is it? Who's it from? How far up is it?
Jefferson, I think just posted.
What's the time of it?
2:10 p.m.
2:10. There's a lot of them. Sorry, I'm skipping over them. Jefferson. I wonder, what is your vision on the implications of DeFi and the gradual elimination of middle people for economic growth, especially in developing economies? It's a hard one to understand. I'm not quite sure what you mean by gradual elimination of middle people here. I think you're talking about financial intermediaries. If that's the case, then it's quite true that traditional financial intermediaries are going to have a very hard time unless they start moving into DeFi and competing where the market is. Economic growth and developing economies, well, I mean, the outlook all depends on education. That's why I put my last year's lectures onto a YouTube channel for anybody to watch, so that at least, of course, last year was, everything has changed since then, but at least you get an entry-level understanding. So go to my YouTube channel. You can find the link on my website, and educate yourself so that you can keep ahead of the curve.
And we can see your ex-PhD students posted another question. Any views on OST, Terra, and the Luna network with 19.5% interest?
I don't have any views on that yet, Ali, but let's take that offline, okay? It'd be really good to connect about this, particularly since I know that that's something of particular interest to you. Yeah,
we can see lots of questions still popping up. I might just let you to choose, Carol, see which ones you would like to answer here. But I do want to remind the people, like Carol shared her website link, and do feel free to have a look at Carol's blogs, and that's the best place to interact with
You can ask questions on the blogs as well. There's places to do that. Jenny, let's move now to wrap up, because it's an incredibly busy day for me today. So
no problem at all.
Are there any other questions or comments that you wanted to discuss before we leave?
Sure, I do have a couple of questions coming from other platforms that I wish you could cover. So first of all is, fintech seems having become a hot topic for international students over a short period. So how long we have been teaching this subject professionally at a degree level in the UK, and how has the teaching been evolving in the past years?
Well, fintech is not just DeFi, okay, and fintech is machine learning, robo-advising, all sorts of other things as well. And although we at Sussex were the first to introduce a BSc fintech and a master's in fintech risk investment analysis, other universities have also very quickly followed suit. Tends to be a sort of collection of informatics, mathematics and finance modules thrown together, and you see, what we need for fintech are academics that are prepared to spend the time to retrain and not teach the capital asset pricing model again and again, or not just teach cryptography in a maths department, but teach elliptic curve cryptography, zero knowledge snarks, and all the other things that are particularly relevant for blockchains. So there are universities like Edinburgh and Durham and Bristol and other places where they are running joined up degrees, not just Sussex in this area, but you have to be careful about which degree you choose.
That actually leads to my final question here is, like you mentioned, a lot of universities do offer degrees in fintech. But when students look for a suitable university for starting this subject, what should they look for to make sure this is the right choice for them?
Well, look at the particular modules, you know, so there'll almost certainly be a module in machine learning, right? Mm-hmm. But how joined up is that to the applications of machine? It's not just, okay, you may learn about machine learning, but what you need in order to get a job, you need to know how that's applied in decentralized finance and fintech.
Thank you very much.
That's just one example. It's just look into the modules and make sure that they actually have the applications that are going to give you a job. Otherwise, you just learn a skill and you have no understanding of how to apply it. Most of these universities are just giving you a tool, and you know, okay, you go, if you haven't had the practice using the tool, then you're not a skilled craftsman. All you have is like you've bought a box of tools, but you don't know how to use them.
Sure. So that would be, you know, depends on what kind of like current bank and finance industry require for the employers. So if you know, to wrap up today's session, so for our prospective students considering this field, what kind of skills they really should keep in their mind to make sure that they can have the competitiveness in the future?
Well, it depends. I mean, there's a lot of jobs in fintech and DeFi, and there are two types of skills that are really in demand. One of them is Python programming. Okay, and if you like, and mathematics, of course, you know, sort of building models in looking at big data analysis, building a model, doing Python programming, not just the programming, but actually understanding the maths to actually put it into a proper code, understanding how to look at the outputs, managing the data, cleaning up the data is most important, especially in crypto. Really clean the data, put it into a good model that's properly validated, put the outputs, and you know, quant analytics is a huge demand for people that can do that. And you don't really need to know much about the business space in order to do that. And then there's the other huge demand is for people on the sales, customer relations, people that can communicate, that that know enough about the DeFi ecosystem, which is a bit like, you know, the film Avatar. You know, that's what the world of DeFi is like. It's like another universe. And if you don't have to be a Python programmer, or you don't have to be good at maths, you just have to understand what that mushroom is, or what that rainbow is, or what these structures are, and be a good communicator. So those are the two areas where. And I think that we actually at Sussex, we need to join up quite a lot of what we do on the digital marketing side with all the DeFi side. And that's one of the aims for the next year.
Thank you so much, Cara. I can see some audience actually ask questions like, when you're going to publish your DeFi book? And that's that's a quite funny question.
I wish I had time. Honestly, I really do have to write a book. But if I do, it won't be a book. It'll just have to all be online and updated monthly. You know, all I can manage at the moment are blogs and past videos, and you have to make your own sort of OTC, over the counter, or on-chain, a bespoke product by just following. I put a lot of news out on LinkedIn, less so on Twitter.
Thank you so much, Cara. Thanks for your time, and thanks for everybody's time today to join today's webinar.